Hi, welcome. Very good evening to everyone. Once again, I hope that you are all safe, healthy, and are doing well. Uh, for those of you who have joined us for the first time, this is a platform that we use for knowledge sharing. We try and cover topics that are relevant, that are contemporary. We don't wait necessarily for the quarter end to approach before we start disseminating knowledge. So do follow us on LinkedIn, do follow us on our websites. We do capture some of the recent regulatory updates as they are announced on our LinkedIn page. Happy to receive any feedback that you have in terms of what kind of topics you would like us to cover, what kind of uh, thoughts you have on some of these contemporary topics. On that note, let me straight away get into the presentation that we have for today. To give you all a quick recap, we covered 5 key themes around CARO 2020 reporting. And sorry, the first theme that we covered last time was the treatment of non-financial assets. To give you a quick 2-minute recap on what we covered last time, we started off by talking about the requirements related to property, plant and equipment, investment property, right of use assets, non-current assets held for sale. Then we looked at requirements related to inventories and intangible assets. Key requirements for a quick summary are that CARO 2020 will require management to have a summary information, quantitative details. They will require management to periodically verify these non-financial assets. Any discrepancies that arise on verification would now be reportable. Any revaluation that was carried out during the year is also reportable. Also, it is required that the revaluation is carried out by a registered valuer. Moving on, in the next theme that we saw last time, we saw the theme around loans and investments. A very relevant theme for those in financial services, NBFCs, and the likes. This theme focuses a lot around how are the sources or how are the application of funds that have been raised or sourced by the company being managed. So a lot more scrutiny on utilization of assets. If loans have been given to parties, the parties to which loans are given now is not restricted to related parties but covers any kind of loan that the entity gives, any kind of investment or guarantee that the company makes. So the scope has been significantly enhanced. A lot of focus around end use of funds to whom the money has been given. Any instances of evergreening have now got to be identified by the auditors. If there are accounts that are overdue, management needs to take steps to ensure that the recovery processes are on. Auditor now needs to qualitatively comment on some of those points. And accounts or amounts that are overdue for 90 days or more have to be specifically reported in terms of the total amounts that are overdue for more than 90 days. So in sum and summary, a lot more scrutiny around the deployment of funds on the asset side. We then turned our attention to the governance related clauses. Here we looked at the kind of clauses that dealt with compliance with laws and regulations to a large extent. Most of those clauses have remained unchanged, barring the exception of the discussion around specific mention of unrecorded income, which was offered for tax as part of the assessments, but was not recorded in the books. Other than that, we had a very quick overview of clauses around reporting under section 185, 186, which is loans and advances and investments, reporting around compliance with deposit acceptance norms, compliance with, for example, related party transaction related controls and governance, the section 177, 188 compliances, the compliances in respect to section 192, all of those remain unchanged. Further, in terms of statutory dues, once again, from a practical standpoint, no significant change with respect to statutory dues payable reporting. So with that short real short 2-3 minute background, what we will try and cover today are the clauses related to borrowings and capital raising, clauses that impact audit and auditors, and finally certain additional regulatory compliances or governance related matters which we did not pick up last time. So a lot of new clauses are applicable in terms of what we're going to talk about today. Some very interesting clauses, and the key theme from a CARO 2020 standpoint really has been that a lot of items are available to the MCA, are available to stakeholders, but they want auditor to put special focus on those items and specifically tailor their procedures and report back in their audit report. I think that's one real key theme that runs across this entire CARO 2020. For example, and we look at some of those when we look at the points related to borrowings and capital raising. To summarize this theme, we cover clauses that relate to borrowings, utilization of funds. We cover a wide range of topics that deal with how does the entity do liquidity risk management. We then talk about the entire going concern assumption, or if there is a material uncertainty around whether the entity will continue as a going concern or not. Some of those assessments have to once again qualitatively form a part of the auditor's CARO opinion. So a lot of effort, a lot of focus on trying to look at how is the funds that are raised managed by the entity and whether they are sensibly deployed or not. So again, a lot of qualitative items that the auditor needs to focus on. So let's look at the first set of items that deal with borrowings, and we'll then, like last time, take each one of them a little more depth and talk about what the key changes are. So the first item that the auditor needs to report on is default in repayment of loan or other borrowings, or in payment of interest to any lender. Typically here, the reporting expectation is that the period of the default and the amount of default is going to be reported. The next item that the auditor needs to report on is whether the company is declared as a willful defaulter by any bank or financial institution or any other lender. Again, a very interesting kind of a clause, because if one had to really look at this particular requirement, the list of willful defaulters declared by banks or financial institutions are available publicly. Any lender, any reader of the financial statements can do their own search and get that list. But the MCA wants to enhance the reporting by auditors and to enhance that requirement from auditors to enhance the extent or coverage of audit. This is now forming a part of CARO. So once again, the auditor may not have too much of effort on their own, but this is something the auditor will have to look for from an external standpoint and comment upon. The other item is around end use of funds raised from term loans. So here the key thing is, if the loans were deployed for the purposes for which they were not raised, then the amount so deployed and the nature needs to be reported. Once again, a very relevant clause from the standpoint of the lender, and for those who are associated with a credit function in a bank, or those who have been borrowers will know that where the funds are going to be deployed is extremely critical for a lender. That onus is now cast on the auditor. Some of these items did form a part of the earlier versions of CARO. So for example, if one went back a few years in time, utilization of funds raised on short-term basis for long-term purposes was a specific requirement under CARO. It's new when one compares it to CARO 2016, but if one went to CARO 2002 or thereabouts, one will see that this was also a reporting requirement. Diversion of funds, misuse or misappropriation of funds raised by one entity and being deployed to other entities in the group. These are some of the common instances that one has seen. Diversion of funds is a key issue that is coming out in some of the recent trends in corporate in India. To correct those, two clauses have been specifically talked about from the standpoint of CARO 2020. Any fund that is raised to meet the obligations of subsidiaries associates and joint ventures need to be specifically commented upon by the auditor. So for example, if the holding company has raised money and has given a loan to the subsidiary to meet the subsidiary's obligations, then that is something that could get reported here. And finally, uh, there is a lot of focus around whether the fundraising has been made by pledging of shares in group entities, and whether there has been a default on such loans. Again, one of the common themes that came out in the recent events in corporate India is the loans were raised by pledge of shares of a group entity, and eventually, if the group entity did not do well, the lenders suffered, and now they want to try and put the onus of whether there is a default on the auditor, and want the auditors to be that much more engrossed or more detailed in their audit approach. Let's look at each one of them in slightly more detail, and we'll talk about the specific facts. The first one that we should talk about is default in repayment of loan or other borrowings, or in payment of interest to any other lender. The requirement here is effectively to report two things. One, whether a default has happened, and two, the amount of default that has happened, and there is a specific format that is prescribed. Two interesting pieces in terms of the scoping. The first one, as you can see on the slide, is instruments like preference shares are not considered to be borrowings for the purposes of this clause. You will recall that under Ind AS, the classification between liability and equity is driven by the substance of the arrangement rather than the legal form of the paper. So one could have a preference share which is mandatorily redeemable, but it is classified as a liability, not as capital. One could have preference shares that are compound instruments, i.e., there is an element of equity and liability both, by the issuer. Split accounting is followed, where the liability is presented as part of borrowings and the equity component is shown separately. So from the standpoint of applicability of this clause, any default in repayment of preference shares are scoped out. So one only looks at loans and borrowings and the repayment and payment of interest thereon. Interestingly, the non-compliances with respect to deposits or defaults in respect of public deposits is also scoped out. You will recall that there is a specific clause under CARO 2020 that talks about compliance with section 73 to 76. And hence, to avoid any sort of duplication, what is really done is that has also been scoped out. Now, what is it that the auditor really needs to disclose? The auditor should disclose all defaults committed during the year and the number of days of default. So if you read the clause, you will probably think that the reporting obligation is only defaults during the year. But there is a format which is prescribed, and the format suggests that if the default is continuing at the balance sheet date, one would then also need to give the number of days of default for those items, irrespective of when the default has occurred. So to give you an example, if an installment was due on, say, 31st of March 2020, and there was a default in payment of that installment, come 31st of March 2021, if the company is still in default of that particular payout, the auditor needs to report that there has been a delay or a default that has been in existence for even the loan that was actually due on 31st March 2020. So that loan which was due in the previous year and had defaulted, if it continues to default at the year end, then that becomes a reportable item. Another nuance that I would like to highlight to you, and that's what you can see on the slide, is when the auditor reports the number of days of delay or the number of days for which the default has continued to exist, the auditor needs to consider the number of days right up to the date of the audit report. So for example, let's say the audit report is to be issued on the 15th of April and the loan continues to be in default as of that date. In reporting the defaults, 15 days of April will also get added. So you look at defaults that existed at 31st of March, but when it comes to reporting the number of days, you extend your assessment and take the days of April also into consideration. So a small nuance relevant for those who are auditing, while we really do hope we don't have these kind of disclosures to make in our financial statements, but a relevant point nonetheless. With that quantitative disclosures, let's now move on to an interesting requirement around willful defaults. So the first thing that the guidance note clarifies is that this particular declaration of a willful defaulter should only be restricted to the relevant financial year, and it should go on until the date of the audit report. Now, what is important is to consider what is it that the RBI to be willful default. And let me spend 2 minutes on what RBI considers to be willful default. If one goes to the RBI 2014 circular, one will realize that certain events, if they happen, are indicators when a bank or a financial institution would classify a borrower as a willful defaulter. Commonsensically, as the name suggests, that if an entity has the capacity to honor its obligation and yet defaults on its obligation, then that is one of the indicators of willful default. So if an entity has defaulted in repayment of obligation to the lender, even when it has the capacity to honor those obligations, it is considered to be a willful default. Another instance of willful default is where the fund was raised for a specific purpose and it was not used for that purpose, but it was diverted. That again is a situation in which the bank can call out that particular borrower and classify them as a willful defaulter. The third one, the third situation once again is if there has been a fraud, if there's been siphoning off of the funds, then obviously the logic is that the funds have not been utilized for the purpose for which it was used, neither are they available with the company for repayment, and therefore that also classifies to be an instance of a willful default. The last one could be, for example, where the fund was deployed in an asset, the asset got sold off, but the fund was not yet repaid back to the bank. So if I have a secured asset, the asset got sold off, the asset as a security is no longer available, the lender was not informed of this fraudulently or willingly or voluntarily, then that's an indication of a willful default, because the seller or the borrower sold the asset without a formal approval of the lender. Now, when it comes to reporting under this clause, couple of relevant items to keep a note of. The first item to keep a note of is that company A, for example, may not have taken a loan from bank A, but if the bank A has identified company A as a willful defaulter for any specific reason, maybe it's part of a consortium, there is no direct lending, and there is a willful default that another consortium member has made. But if bank A also calls this particular company A as a willful defaulter, then the auditor will be forced to report. The auditor cannot say that I don't have any relationship or contractual relationship or an existing borrowing with bank A. Bank A has declared company A as a willful defaulter. That logic does not work. The moment the willful defaulter tag is applied, the auditor will be forced to report. When it comes to who or which entity can apply that willful defaulter tag, the willful defaulter announcement can be made either by a bank or a lending institution, in which case the auditor will need to reply party by party who has declared them as a willful defaulter. If any amount is owed to them, then that amount needs to be disclosed. However, there are certain situations in which a government or a government authority can also classify someone as a willful defaulter. Now, those are also to be considered for the purposes of this reporting. So in the clause, when you read other lender, the other lender has a very strict interpretation, and that strict interpretation is that other lender only means a government authority or a government agency, and not any loan, any other party. So say company A has taken a loan from company B, and company B believes that the loan was not used for the purpose for which it was taken. Company B calling this entity a willful defaulter will not trigger any reporting under CARO, because company B is not a government authority, neither is it a bank or a financial institution. So those were the 2 or 3 salient points that I wanted to highlight from the standpoint of declaration of willful defaulter. So one of those interesting items, this information is publicly available, and yet CARO 2020 requires the auditor to comment on this particular item. Moving on, the next thing which is quite critical is end use of funds. Now, in the recent past, a lot of frauds, a lot of events have happened in corporate India where the end use of funds was questioned. The MCA requires that the auditor now pay special attention to some of these items. The first thing that the auditor needs to do is to comment on whether the funds raised from term loans were deployed for the purposes for which they were raised. And if not, then that is what the auditor needs to call out in CARO 2020. So what is it that really triggers, or what situations or scenarios trigger reporting under this clause? And I'll talk to you about 2 or 3 examples while you can see some of the summarized points on the slide. If the utilization of short-term working capital funds is not in accordance with the sanction, but is made to use or put to use to acquire long-term assets, then that is an item where the reporting could get triggered. So typically, if you have raised any short-term money, deployed it for a long-term purpose, it will mean that the end use objective is not met. Or you use it for a purpose for which it was not raised. And this is quite a challenging item from an audit standpoint, because friends, you will remember that money is fungible. Money does not have color. The money that gets credited to my bank account does not know whether it is coming from a short-term source or a long-term source. You could see companies having separate bank accounts to segregate some of these items, but it's not always practical to do a 1:1 correlation. The guidance note fortunately does not require that kind of 1:1 correlation. One really needs to look at first, what are all the loans or term loans that have been received? What was the objective of the term loan that was stated in the document of the sanction letter or the agreement? And then you start looking at deployment. You could look at deployment from a fund flow perspective. You could look at deployment from a 1:1 tagging perspective. So to give you an example, let us say a housing finance company or an NBFC company raises money by way of a term loan, by way of an external commercial borrowing. There are certain set items in which this particular proceeds can be deployed. So for example, they can be used for home loans, but not to fund real estate. Now, in this case, what would typically happen is the auditor will generally be able to see 1:1 correlation, because the management would also like to keep this aside in a separate bank account or a fixed deposit account. And as and when the relevant home loan disbursals come up, those disbursals are made out of these proceeds. So in some cases, it is very easy to track. Management may also be in a position to demonstrate compliance, but there will be equally in number instances where the 1:1 correlation does not work. the guidance note or law does not mandate 1:1 correlation. So coming back, deployment of funds, if they were deployed for the purpose for which it was not raised, again is a breach. If the funds have been transferred to other subsidiaries or group entities, that again is a challenge. Routing of funds without the permission of the lender is also a challenge. And it's therefore extremely critical as from an audit standpoint to try and look at it from a fund flow perspective. So let me take an example to try and illustrate what is acceptable. So let's say that the documentation or the sanction letter and the agreement says that the loan will be used to purchase machinery which manufactures or helps manufacture tires. Okay, now if the company uses this money to buy a machine which in addition to manufacturing of tires also helps them to manufacture a byproduct, then that will not be considered to be a breach or will not be considered to be a situation where funds were not raised for the purpose for which they were, funds were not deployed for the purpose for which they were raised. So careful attention, little more depth or detail required to do this. And 2 points that I would like to specifically talk about from the point of view of the slides is that there could be a situation where the funding is raised near the fag end. It's raised right at the end of the year, in which case deployment will not necessarily happen at that time. One commonly understands that this fund could be parked in a fixed deposit, which is then withdrawn at a later period of time. In which case it is the responsibility of the auditor to bring this out in CARO that the money has been raised, has been temporarily deployed for or in deposits, and the deposit will happen subsequently. What that therefore also means is if the term loan was raised in the previous year, at the fag end of the previous year, the auditor will need to comment on the utilization in the current year. So those were the two sort of minor points that I wanted to highlight. Extremely critical from an audit standpoint because lenders can get a lot more information by looking at the CARO 2020 report. The lender's job is slightly simpler now because the auditor is going to do a lot of that kind of work for them. Let me now move on to utilization of funds raised for short-term basis. So the genesis of this, or the fundamental principle of financial management, is that a long-term asset of an entity needs to be financed from long-term funds. Just think about a situation where a company issues commercial paper, and using that money by issuing commercial paper, it starts building a plant which will only start generating money 3 years later. So if one uses funds raised by issue of a 90-day commercial paper and deploys it in a fixed asset where the revenue only starts earning from year 3, it's a basic mismatch in the way in which the fund is intended to be used and the manner of raising of the funds. And this really goes against the basic fundamental principle of fundraising, that you will use short-term money to fund long-term purpose or long-term assets. And this is an exception that is really specifically what CARO requires us to call out as auditors. This is not a new clause. This clause existed, as I said earlier, in the earlier versions of CARO. Once again, given what's happening in the current scenario, given what has happened with some of the other financial services entities, where entities borrowed money on commercial paper and they expected or hoped that they will keep on renewing, keep on rolling over the facility, such that at some stage when the asset matures, those proceeds will be used to set off the liabilities. At some point in time, unfortunately, that cycle has to break. And when it breaks, it could cause severe stress in the entire system. So therefore, to save that 9 stitches, this is a stitch in time that CARO 2020 requires. Uh, Again, application of funds, as we said, which is not long term, is to be classified as short term. So the guidance note has some uh, interesting points around this, and it gives examples of what is long term purpose. So it says if an entity is investing in fixed assets, property, plant and equipment, investment property, long term investments, long term loans, those are all long term purposes or long-term application of funds. Anything that is not a long-term application of fund is a short-term application of fund. Finally, when it comes to assessment of what is a short-term basis or what is short-term funds, one will need to be careful and do the assessment. So this clause therefore primarily requires the auditor to comment on whether funds have been raised for short term have eventually been used for the long term purpose or not. Moving on, again a very interesting point: funds raised to meet obligations of subsidiaries, associates and joint ventures. Now normally what is expected is that when the company has taken any funds from an entity or a person and has granted a loan to its subsidiaries, associates or JVs, then reporting under this clause should trigger. The idea of this clause is to really be able to trace the utilization of funds. Now, what is interesting in this clause is the definition of the term obligation. The term obligation is including not just repayment of borrowings of the subsidiary, associate or JV. So it's not that the subsidiary or associate or JV needs to have their own loans and debentures that are maturing. Even if the amount is lent to them to repay or to pay statutory dues, to pay out expenses, to pay out employee payments, those could also potentially get covered in the reporting under this clause. Now, this is a practically extremely challenging clause because you could have group structures where an entity raises money at the top co and then disburses them at the subsidiary or associates or JV level. Now once again, I think from a factual standpoint, one would really need to assess as part of the holding company's auditor what is the utilization of the funds that have been raised by the subsidiary from the holding company. So let me take an example where company A raises a term loan from a bank. That term loan raised from a bank is given by A to A's subsidiary. Now, on a plain reading, this would mean that this is reportable. One could actually practically challenge this by saying that what is the fundraising position or the financial position of A's subsidiary? If A's subsidiary can demonstrate that their obligations, their liabilities can be met through their own funds or through funds other than the holding company, then it is possible that one could end up not reporting anything here. But otherwise, this is likely going to be a reportable matter. So a very common situation in the financial services is you have a core investment company where a CIC actually raises the money. The whole objective of a CIC is to lend and invest in its subsidiaries. While this is still a new reporting requirement that we are dealing with, and hopefully guidance should evolve, if you ask me, my personal view would be prima facie, this could trigger a requirement. Unless the subsidiary is able to demonstrate that, by the way, we also raised a lot of more money from other banks on our own strength, on the strength of our own balance sheet. And therefore, what was raised from the holding company was not really a significant amount. So extremely situation-based, facts-based, and judgment-based. In fact, a lot of clauses that we have discussed today are extremely judgmental. And you will see that when we discuss some of the clauses related to auditor reporting also, that is extremely judgmental. And that's why our recommendation is to start the dialogue with the auditors right away, because for questions like these, practices will evolve, guidance will evolve, positions will emerge. But better discuss those positions now than wait for 15th April to begin the discussions. The last point that I wanted to pick up in respect of borrowings was, if there is a loan raised during the year by pledge of shares held of a subsidiary, associate, or of a JV, then that needs to be disclosed. And if there was a default on those loans, then that fact needs to be brought out. So once again, the objective is to try and tighten the reporting around uh, the entire fundraising. From whom have the funds been raised? Where have they been deployed? Has there been a diversion? Is the company declared a willful defaulter? All of that is going to provide immensely useful information to people in the credit function in a bank or an NBFC, because you will now know at one stretch, in one opinion, as to whether this entity does diversion of funds or not. You would have otherwise had to look at your own analysis of the end use of funds. Now you have an auditor who is taking responsibility for the statements they make in the opinion. So interesting times ahead as we explore some of these typical holding company, subsidiary company fundraising arrangements. The next clause is around liquidity and going concern, and I'm calling this as a sub theme of liquidity and going concern. What is it that the auditor needs to report? The auditor needs to report whether there is any material uncertainty that exists on the date of the audit report. So important, the date is date of the audit report, about the company's ability to meet its liabilities on the balance sheet date, as and when those liabilities fall due over the next 1 year from the balance sheet date. So to simplify the timeline, take the cutoff of 31st of March 2021, look at all the liabilities that are due within 1 year from 31st March 2021, and then perform the assessment whether the company will be able to meet those liabilities. But the assessment that is done as of the date of the audit report. So let's suppose that there is a planned equity infusion by the holding company. It's been approved by the shareholders of the holding company. Allotment of shares is pending, but all other formalities have been done. That particular critical piece of information after 31st of March, but before the date of audit report, would need to be considered by the auditor. So you look at the position as of 31st of March, but please do consider some of these qualitative inputs between the 31st of March and the date of the audit report. We also come across opinions or entities where the auditor brings about or reports a paragraph in the main audit report around material uncertainty related to going concern, or it could be a key matter around the going concern assessment. If something like that is existing in the main audit report, the auditor should duly consider this while reporting under this clause under CARO. They could probably even draw reference to that particular main audit report. Now the key question is, having understood what is it that is to be reported, let's now spend another minute or two on what does the auditor need to do to be able to comment on this. What the auditor needs to do to comment on this is basically look at what is the kind of liabilities that are due. The auditor needs to then look at what are the assets that they have which they can use to basically meet those obligations. The auditor needs to bring on the table their understanding of the company to say whether what the management believes about being able to pay off the liabilities can indeed be possible or not. The auditor needs to look at the other information that is accompanying financial statements. So for example, the MD&A and those reports could also provide a lot of inputs to the auditors. So as an auditor, what you would do is look at what are the financial liabilities that are due, look at the aging and the expected dates of realization of the financial assets. Please use your understanding of the company, their management, their plans to see whether these liabilities can actually be met or not. Look at other information that one could see in the financial statements. Now, the guidance note also hints that one could use ratios like current ratios to do this assessment. So if I had to just give you maybe a quick summary of what is expected of the auditors, the liability that the auditor needs to examine should be in existence at the balance sheet date. It should fall due within a period of 1 year. A small nuance I would like to highlight here is that one should not automatically conclude that a current liability is a liability which falls due within 12 months from the balance sheet date. So a slight distinction here I would like to bring about is that let's remember and recollect how a liability is classified as a current liability. A current liability is classified on the basis of the operating cycle, or it could be 12 months. Remember that operating cycle could be more or less than 12 months. So something that is automatically or something that is a current liability in the financial statements does not automatically become a liability due within a period of 1 year from balance sheet date. So this is a slight a nuance that I wanted to highlight, but an extremely relevant clause that the auditor will need to look at. The next item that the auditor needs to look at is whether the company has incurred cash losses in the particular financial year or in the preceding financial year. The term cash losses unfortunately does not feature in any of our accounting standards, neither does it feature under the Companies Act. So what the ICAI guidance note has done is they have provided inputs around how does one go about calculating cash losses. Remember, you have cash flow from operations in the cash flow statement, but that is not quite cash losses. That is not an indicator of cash losses, because you could have companies where there is substantial and relevant interest income or interest expense. Now, if you only took cash flow from operations for those entities and excluded interest income, interest expenses, one would really not get a true picture. and therefore, the ICAI guidance note gives some guidance around how to deal with this assessment. It says, take the net profit or loss after tax as a starting point. Because this is not readily available, please use some form of an indirect item or an indirect approach to get to the conclusion. So start with the net profit or loss after tax, add back non-cash items. Now, it's very easy to understand some of these non-cash items. Certain non-cash items can be quite tricky. So non-cash items like depreciation, amortization, impairment, they are all to be adjusted or added back. Non-cash items like deferred taxes are also to be added back. Now, where the confusion arises is on two items. The first set of items are items that are unrealized in their nature but not non-cash. So for example, if there is a fair value change, while it is not a realized fair value change, one cannot automatically say it is non-cash, right? Because at the end of the day, when one sells this or when this is realized, it is realized in cash. At that time, it will impact cash losses or cash profits. So to clarify or to put a rest to all of those kind of issues, the guidance note once again brings out a statement to say that foreign exchange gains or losses, fair value changes, whether they are gains, losses, they all need to be adjusted to the net profit after tax. For companies that follow Ind AS, the second item which could cause confusion is OCI, because there could be items that are first parked in OCI and then are reconciled to the P&L. So to give you an example, if there is an item of a cash flow hedge reserve it is sitting a part of in OCI in the current year, but in the subsequent year when the underlying item hits P&L, that amount gets reclassified from OCI to P&L. And if my starting point is net profit or loss after tax, the reclassification is sitting in this amount, whereas actually the transaction had been triggered in the earlier years. So again, a tricky item in terms of how one deals with this. Two possible conceptual approaches possible. One conceptual approach is to say, I will start with net profit after tax, after OCI, or I will include my comprehensive income for the period and then do this assessment. Or I will start with net profit after tax and then manually specifically adjust items that are realized or recognized but are sitting in OCI. Once again, not a very clear-cut assessment, not a straightforward assessment, but this is where the guidance note has left it at. So what will be our key takeaways from this is that cash losses or cash profits are not cash flow from operations. They are not distributable surplus. Interestingly, if there is a qualification in the audit report, if that qualification is quantifiable, then the cash profit needs to be arrived at after giving impact to the qualification. Something similar to what you would see in preparation of restated financial statements for an IPO. And finally, the reporting is for current year as well as preceding year. So if there is no cash loss in the current year, but there was a cash loss in the preceding year, then the auditor would need to separately report this, saying there is no cash loss in the current year, but there was a cash loss in the previous year. That brings us to a close around what is required to be reported from a fundraising standpoint. If one had to look at the other clauses in CARO around raising of equity shares, raising of preference capital, preferential allotment of shares, and those kind of clauses, absolutely no change between CARO 2020 and CARO 2016. So with that, let's move on to the theme that deals with audit and auditor related requirements. 6 points that I wanted to highlight in this. The first point is that the scope of the auditor on fraud reporting has been widened. If you remember CARO 2016, it was only frauds committed by or against the company by officers or employees of the company was what was covered. Now the word officers or employees has been taken off. So any fraud, a fraud by a customer, a fraud by an employee, by management, all kinds of frauds are covered in the ambit of reporting here. So the scope has been significantly enhanced, and the moment the auditor has either noticed it or it has been reported elsewhere in a regulatory reporting, the auditor will now need to report this back under CARO. So as an auditor, look at the internal audit reports, look at audit committee minutes, audit committee meetings, the moment they have noticed it, right? Because if I read a regulatory submission and I see a fraud of 100 was committed by a customer, which is reported to my regulator, I have noticed that fraud. I report that in CARO, and I also talk about the nature and the amount involved. So expansion in the scope of work, expansion or requirement of for the auditor to now be more aware of what's happening in the entire company. The other requirement is around reporting by frauds to the central government. You will recall that section 143.12 rule 13 to this particular section requires auditors to report frauds that they have identified during their audit to the central government. So if there are frauds which are more than 1 crore, that need to go to the central government, otherwise to the audit committee, and there is a set manner of reporting. Now, the MCA has put the onus back on the auditors to state that any frauds that were reported to the MCA in Form ADT4 have to be reported under CARO, so that anyone who picks up the balance sheet and the audit report will know what were the frauds reported to the MCA. Also, a very interesting thing is if there has been a change in the auditor, then that is something also that will need to be factored in by the incoming auditor. So let us suppose that there was an auditor who was there in office till July, and that auditor had made or filed a submission in form ADT4 of a fraud. Subsequently, the auditor resigned or did not get reappointed, and a new auditor was appointed for the year ended 31st March 2021. Now, the auditor in office at 31st March 2021 has not done the reporting in form ADT4, but because the predecessor auditor has done that reporting, it's incumbent upon the current auditor to report it. So that's the small point, the fine print that I wanted to bring out here. Whistleblower mechanism, whistleblower complaints, unfortunate, but a lot of increase in the number of such instances or complaints. Now, a couple of points of note with respect to whistleblower complaints is the first thing one should keep in mind is whistleblower complaints don't relate only to financial reporting. They don't relate only to financial reporting. It could be misconduct, it could be bribery, it could be anything. What one really needs to consider is, as an auditor, have I factored in those whistleblower complaints as part of my audit procedures? Have I considered the impact of those on either the financial statements or controls? Or as part of my audit, if I need to change my auditing procedures or approach, then have I considered those appropriate? So something where the auditor needs to specifically focus on. Now, the guidance note and CARO 2020 talk about complaints received during the year. The auditor's responsibility is only for the complaints that were received during the year. But if that complaint pertained to a period of a prior year, it would still be relevant for the auditor to assess. So let's say somebody files a whistleblower complaint in the current year for a possible fraud or an unethical treatment that happened 2 years back, then that is something the auditor needs to take cognizance of in the procedures. Once again, there are companies who are not mandatorily required to have a whistleblower mechanism. For those companies, all that the auditor needs to do is assess whether there is a whistleblower mechanism that is in place, whether complaints have been received or not, and how have all of those been disposed of. So once again, it's not only for those to whom whistleblower mechanism is mandatory, but also for companies where whistleblower or vigil mechanism is not mandatory. A good way for them to enhance their level of governance in the company. The other 3 items were related to audit and internal audits, or rather the other 2 items were related to audit and internal audit. Now, in a couple of versions of CARO back in time, the auditor had to comment whether the internal audit system was commensurate with the nature and size of the company's business. That reporting requirement has found its way back in CARO 2020. If you ask me for my personal view, the view is that the MCA, the stakeholders, the governments, professionals, they are all now trying to give internal audit its due, give internal audit the real responsibility it has, and therefore make businesses, make managements wake up to the fact that they have a critical role to play. So an internal audit is actually a function that performs assurance and consulting activity with the objective to evaluate and improve the effectiveness of governance, risk management, and internal controls. So the statutory auditor should therefore, in reality, discuss the scope with the auditors, meet the auditors, understand from the statutory auditors or the internal auditors the nature of work that they do, the extent of work that they do, the kind of company that they are auditing, the business that they are auditing, and then take a measured view of this particular item. Judgmental, but critical. A new clause that has been introduced this year is whether the reports of internal auditors have been considered by the statutory auditor. Once again, very important, what the guidance note now requires is that the auditor should not just read summary or annexures, they should have full access to the entire report. Typically, you will see a detailed report and an executive summary and an even smaller summary that gets placed in the audit committees. The auditor needs to have access to all the reports. Importantly, if the auditor does not get timely access, the auditor will have full freedom to go ahead and report under CARO 2020 to state that we did not receive the reports on time. In fact, the guidance note even says that the engagement letters with the stat auditors need to be modified. So all in all, from points 4 and 5, the takeaway is that the focus on the quality of internal audit, the internal audit as a function, is important. Statutory auditors will now also need to look at their findings, look at their comments on internal controls, and ensure that they don't have an impact on the audit opinion and the IFC opinion. So an additional step that the auditors will now need to have and demonstrate this as part of their file. Finally, if there is any resignation of a statutory auditor during the year, then the new auditor that has got appointed will need to report this to the MCA. So with that, the last theme that I wanted to pick up in the last few minutes that we're left with is around some of the other governance related clauses. A lot of focus has now been coming out in terms of CICs. There are 4 clauses in all that deal with core investment companies and NBFCs. The first one is that the auditor needs to comment whether the entity needs to register as an NBFC, and if yes, whether it has registered itself or not. And let me give you a recap in a minute about what NBFCs or these entities are. Now, a registration is required with the RBI if an entity is engaged in the business of non-bank financial institution as defined in the RBI, but this should be the principal business of the entity. The whole idea is that if any entity's principal business is non-banking financial institution, they need registration. They need oversight by the RBI. And there is an RBI FAQ which talks about what is principal business. So if the financial assets and income from those assets are more than 50% of the total assets and income, then that is deemed to be carrying out financial activity, and registration is mandatory. So once again, the idea is that if any such business activity is carried out, there is exposure to public at large, and therefore whether they are being regulated in the right manner or not. Now, once the business has been conducted, whether they have a valid certificate or registration or not is also something that the auditor needs to comment on. The 2 other interesting clauses is, in case of a core investment company, whether it continues to fulfill the criteria for being a CIC, and whether it is required to be registered or whether it is exempt from registration, and whether those criteria are fulfilled or not. So to give a quick background of what's a core investment company, a core investment company is also an NBFC, but by definition, they have to hold at least 90% of their assets in the form of investments in shares, debentures, preference shares in group companies. And the investment in equity shares of those group companies should not be less than 60% of the assets. So basically, this is more like a top core, holdco created at the top. If they meet that condition, if these 2 conditions are met, then they need registration. And for an exemption from registration, the net assets have to be less than 100 crore. So once again, fairly objective and quantifiable criteria. The last item that you see on the slide here is around a factual statement of the number of CICs in the group. And if there are more than 1 CICs, then that fact. So again, a bit of background from a regulatory standpoint is that normally one group can only have 1 CIC. However, if the RBI specifically approves, you could have more than one CIC. And in June or July 2020, the RBI has come out with guidelines where the CICs will slowly need to move to a situation where they end up with one CIC in a group. Because the idea is that if you have multiple CICs, you can leverage multiple times and it creates a systemic risk. The group could collectively end up borrowing 11 times the capital that they have. That is considered to be risky from a systemic standpoint. So once again, relevant information that the regulators could get if they look at the audit reports of CICs. And you will find about 4 or 5 groups who have more than one CIC as part of the whole group. So that's the NBFC and the CIC related item. The last item that I had was around CSR reporting. Now, you will recall that if there is an ongoing project, or rather, if there is a project which is not an ongoing project, and there is any unspent amount, the company needs to transfer that amount within 6 months to a separate fund. So let's say a company does not have a project to which it contributes. It makes a donation, it makes a one-off spend. If at the end of the year, they've not spent the 2% that they were required to spend, within 6 months, they will need to transfer this. So what could happen is, typically the balance sheets get signed off by April or May or June, but they have 6 months from the end of the year to sign off. So it could happen is that the auditor signs the audit opinion, but the spent or the unspent amount is not transferred, in which case this statement of fact will have to be brought out. The second subclause that is there basically talks about where there is an ongoing project and an amount is unspent. So for example, there is a project where the company is building a school. They were required to spend 10 rupees during the year. They only spent 5 rupees during the year. What Companies Act now requires is that the unspent amount of 5 rupees is transferred to a special account within 30 days from the end of the year. And that amount needs to be spent over the next 3 years on this particular school's construction. At the end of that 3-year period, if there is any unspent amount, that needs to go to the special fund. So the idea here is extremely factual kind of requirements to report, but a careful assessment around tracking of this unspent amount is now required both by management and auditors. Currently, this clause is not yet notified, but once this particular subsection of Companies Act under 135 gets notified, this will start becoming mandatory as part of the audit opinion. That is all that we wanted to cover in today's webinar. I hope you found it useful. If there are any questions, maybe we can take them, or please feel free to write to us any questions that you may have, and we'll be happy to come back to you with an answer if we can't answer them right away. So there was one question from Mayur here, which says, if a CIC has borrowed funds from public and used that funds to lend to the subsidiaries of the CIC, whether this will trigger reporting? Yes, absolutely. While guidance is still evolving, prima facie view is it could trigger reporting, because it's an extremely fact-based reporting. And maybe there, either we should hopefully get more guidance, or otherwise the auditor could possibly bring out fact to state that this is a core investment company and it is required to invest or lend to group companies only. So yes, a practical item that we are dealing with. Hopefully guidance will evolve as we go along. Okay, so if there are no other questions, we can call this a close. Thank you very much for taking out the time. Hope you found these sessions useful. If there are any other topics that you think we can pick up for knowledge sharing, please write into us. Please do let us know. We'll be more than happy to meet up on this platform. Thank you. Have a great evening. Stay safe. Have a great weekend. Look forward to many more sessions.